And with the third and final section on the Fibonacci forecasting, that is basic principles relating to change and patterns of change, and then clear distinctions relating to predictions and forecasting and Fibonacci forecasting, and noticing the pattern of what is happening early, quickly, and accurately identifying where life is going, how life is proceeding, the direction of life. If it doesn't change further, we can speculate as to some outcomes. So the specific benefits of noticing things early. Well, consider the practical benefit that you could have experienced if you had been following these instances of Fibonacci forecasting, which some people have been experiencing. These benefits some people have been experiencing. Here's just a sequence of publications and published forecasts. In March 2003, they published an analysis of the circumstances that led to the sharp decline in the stock markets in the U.S. and other leading industrialized countries, especially in the technology sector, leading to the following logical deductions based on that analysis. That precious metals would strongly outperform most U.S. stocks in the next few years after March 2003, which they did. Also that the global credit market was destabilizing and that this would produce big declines in U.S. real estate prices, which also began to manifest by 2005 in the U.S., certain portions of the U.S. And finally, that the top performing sector of the U.S. stock market for the prior few years, as of March 2003, which was HUI, that top performing stock sector would continue to perform well. HUI eventually rose in price by over 1,300% from 2000 to 2008. It was up a few hundred percent as of March 2003. So moving on to another publication, I'm skipping. There's many other publications I'm not making reference to, but in November 2004, I published The Real U.S. Deficit, Oil. This article generally tracked several decades of history concerning the relationship between the U.S. economy in general and the commodity oil in particular. The economic crisis of the U.S. in the 1970s was simply explained as a national instance of what was by then clearly developing into a global crisis relating to oil. In other words, by November 2004, it was clear that there was a similar crisis happening, like a cellular level that's then eventually shows up on the organ level or the organisms level. What happened in the U.S. in the 1970s was showing up worldwide by November 2004, some of the early signs. And in the 1970s, it was certainly possible to expect the same issues that we eventually saw in the last few years of this decade. I say this now in late 2010. So by 2004, there was clearly a bigger manifestation of something that had happened in the U.S. in the 1970s, and logical deductions predicted a future of sharply rising oil prices and the consequences for the U.S. economy on those sharply rising oil prices, including collapsing prices of U.S. stocks. From 1999 to 2008, oil prices in U.S. dollars, in fact, did rise over 1,000%, about 1,200%. And so, as of November 2004, about halfway in the period of time, but less than halfway in terms of the price rise. The latter couple of years of the price rise were the price rise were the steepest or fastest rising of the price. So when oil prices finally collapsed in 2008, U.S. stock prices also plummeted, just as this article had made reference to. Spiking oil prices would interrupt the U.S. economy as we know it, and the economy of many other countries as well, as we've seen. So in September 2005, I published Worth Its Weight in Oil. This article identified some presumptions as myths, then dispelled those myths regarding an alleged inflation in the US dollar. Since rising fuel prices led to a rise in many consumer goods that had been transported over long distances, many people interpreted the rising of the prices of many consumer goods, but not all, as reflecting a fundamental change in the value of the US dollar currency in particular, rather than a fundamental change in the global economy in general, relating to this fluctuation in the cost of oil, relating to a shift in terms of a dramatic flipping where we had increasing demand for oil, but we also had increasing supply. As of September 2005, I'm saying the increasing demand was going up faster than ever, while there was no increasing supply. The supply of global oil flattened and began to drop. So prices rocketed. Confusion about things like the future of the US dollar then led people to very risky gambling on things like US real estate speculation, US stock market speculation, just dumping money into mutual funds with really no concern for the actual companies and the policies of those companies. Had people jumping into annuities contracts with no real understanding of the contract, of the companies behind the contracts. It's just wild speculation. So again, it so happened that oil prices did rocket. Many countries experience and continue to experience unprecedented historic declines in their prices of real estate, in their prices of their stock markets. And we also are seeing waves of foreclosures and bankruptcies in households as well as in businesses, including banks, mortgage lenders, insurance companies, auto industry. It goes on, pretty much across the board. So here's a couple quotes from that September 2005 article. Think about it. Oil is the leader. U.S. stocks followed. I'm talking about changes in price. Oil is the leader. U.S. stocks followed. Oil was in 1999. U.S. stocks followed starting in 2000. The dollar followed them starting in 2002. Real estate will follow next. I wrote that in September 2005. In fact, as of the summer of 2005, just a couple months before I published this, real estate had already begun to follow. Here, back to the direct quote. Every move is predictable, like a wave coming to the shore, through the deep markets to the shallow markets, through the markets far from the shore to the markets close to the shore. So it may not be long before gamblers and speculators in U.S. real estate are suddenly exposed to the order that is evident in all this. They may not understand the domino effect, but they will witness the next domino, an accelerating flood of foreclosures. End quote. Looks like I may not have much time if I'm going to keep this under 10 minutes to comment on the other publications, but there's one in November 2006. That was a video where I said some of the stuff I'm saying in this video, frankly, but I said in November 2006, and then by 2008 it started to be, publicized as, okay, now everybody recognizes it, but the media is calling it a surprise. Because they didn't expect it, or they are not admitting to having expected it. In August 2008, I issued a final warning of an impending collapse in U.S. stock prices, which they then did. In March 2009, I noticed that the U.S. stock market had reached a support level, a point at which it was likely to rebound for an extended period of time before falling even further and faster, which I believe is about to happen in our immediate future. So I didn't read everything I wrote there, but you can read over that. these are just a few examples from the last 7 years of the benefits available from forecasts that I personally made. In other words, in the March 2009 forecast, within a few months, within 5.5 months, the specific investment instruments had increased in value hundreds of percent. In the case of FAS, it was over 300%. I don't remember exactly. I think it was like 500%. It was a lot. So other forecasters besides myself have even longer records of competent and accurate forecasting by applying the principles of nature, the interdependency of multiple levels of scale. We see something happening on the national level in the U.S. Previously, it had happened in local levels and smaller communities, and then in the world, we start to see it in the last decade as it relates to oil and fossil fuels in general.